What's up, guys? Dan here, and today we're joined by our good friend Stephen May. He's a fellow Kansas City real estate investor, and some partners have amassed hundreds of units of storage. He has done a ton of cool stuff that he's going to share with us today. So, guys, tune in while we interview Stephen May and how he became a millionaire through real estate investing at only 26 years old. Let's go.
Yeah, born and raised in St. Louis. Basically pretty traditional route. Went to college here in Missouri as well, Missouri State University. Knew I wanted to get into healthcare. That's all I really knew. I was an athlete growing up, so I actually was pre-physical therapy going into college. Quickly kind of transitioned out of that. Did a couple shadowing hours at a local hospital. Ended up liking the nursing route, so I actually ended up getting my bachelor's of science in nursing through Missouri State University. In that time span, kind of started researching some financial literacy type stuff, mainly, at the time, kind of trading penny stocks while in college, some silly things like that. Never really amassed anything crazy. Somebody mentioned Bigger Pockets to me. So Bigger Pockets is obviously a massive real estate website, forums, tons of books, publishing company. Got into that, of course, read Rich Dad, Poor Dad, kind of just got the real estate bug. It made a lot of sense visually in my head. So long story short, ended up moving here to Kansas City, bought a house before I even moved here, actually. So that was my first purchase, just a classic 3-bed, 2-bath house near Rockhurst University here. That was a house hack. So I had 2-3 buddies that were going to Rockhurst at the time. Some buddies of mine that grew up in St. Louis. So I ended up renting all the rooms out to them for like $450 a month each. So they got a pretty good deal, which I thought worked. And then, of course, that covered the whole mortgage. So that was the start. So I moved to Kansas City, took my state boards test for nursing, passed, was in orientation at the hospital, house hacking. So obviously awesome when you're living rent-free, mortgage-free, whatever you want to call it. Quickly, 8 months later after that, actually ended up buying a second property. So that is actually the house I'm sitting in right now, that I'm getting ready to move out of actually next week. So I've been here about 3 years. Was supposed to be a live-in fixer-upper. Obviously, I've lived here 3 years now. Really like the area. But as I transitioned into this house, that first house, I actually did, a light rehab. So it was an unfinished basement. We finished the basement, framed it out, added drywall, paint, did flooring, trim, all that jazz. Put it up for rent and got a renter pretty quickly. Those renters have actually been there for 3 years now. So they've re-signed every year, which is fantastic. Obviously keeps the turnover cost low, have had no repairs on the house. So that was my first deep dive into being a landlord, real estate investing. And then, kept going, was still a full-time nurse, just saving up. So that was all, I was 23 at the time, bought those 2 houses within 8 months. That was 2019. 2020, actually didn't buy any houses whatsoever.
Wow.
Looking back, I would have, of course, but thought I was doing great at 23 with 2 houses, 1 rental, 1 personal residence. Was trying to work overtime at the hospital to scale up my income. I did plan to keep buying. It was just kind of a slow and steady process. Made an offer on a duplex in Independence here, actually. And it was a seller finance offer.
Okay.
I actually did 3 different offers on it. Submitted 3 offers, 3 different, price points, interest rates, balloons, all that jazz. So the listing agent was pretty impressed with the offer, especially me being 23, kind of getting into that ordeal of seller financing. So she actually wanted to go out to coffee, asked if I wanted to joint venture. At the time, I didn't even really know what that meant.
Sure.
Got coffee. She ended up convincing me to get my real estate license. So I went ahead and did. That was a fairly simple process. Did the course online, got through that in like a week, went and took the state boards, passed that. And at the time, I didn't think much of it. I just thought I'd kind of save on commissions as a real estate agent, buying properties myself off the MLS moving forward.
Just real quick, was that April?
That was April Preston. Yeah.
Okay. Yeah. No, mutual connection. I know the name. I haven't met her, but go ahead.
Yes. And we can talk about that off
sure.
camera because I think I know the connection as well.
Uh-huh.
The two bills, I believe.
Yep.
Anyways, slowly towards the end of 2020, I guess this was end of 2020, got sent a few like leads, was trying to kind of learn how I could monetize my knowledge of real estate via being an agent. Ended up getting my first big deal off Facebook Market. It was a large mixed-use building in the historic Independence Square. Acted like I wanted to rent it. Went and met the lady there, did a full walkthrough, basically ended the walkthrough with saying, would you sell it? What's your price? Would you let me represent you? Got the listing, found a buyer within a couple of weeks, and actually got dual agency. So
wow,
represented the buyer and seller. So any real estate agents listening, obviously you get both sides of the commission. So whatever that was at the time, 5-6%, I don't remember exactly, but basically that was like a $16,000, $17,000 payday once that got closed and funded. So that was kind of a light bulb moment in my head. $16,000, $17,000 commission, that at the time that was like 3 months of work at the hospital. I was grinding it out on night shift. Nursing in the ICU is just not a very glamorous job at times. So that was the light bulb moment that kind of made me think about where I could take this. So that was end of 2020, going into 2021. Slowly started building some out-of-state investing clientele, mainly via social media and mainly via Bigger Pockets. Did a few small deals. My brokerage was handing me a few leads here and there. So it was rough in the beginning. I mean, I was working night shift, coming home, sleeping for 3-4 hours, showing houses, and then going back into the hospital. So it was definitely a grind in the beginning. 2021, so we entered 2021. I only have 2 houses. My personal residence that was kind of fixed up at the time. Had a very low mortgage. I mean, I did refinance that property after I fixed it up, bought it at a great below market price. So that worked out well. The first house, was cash flowing me like $250. So it is what it is. Very small portfolio, very small passive income going into 2021. Ended up making the shift to actually go part-time as a nurse, kind of made the commitment to instill confidence in myself that I could do this entrepreneur route, whatever you want to call it. Let's just say things scaled up pretty quickly. Ended up pulling a HELOC, home equity line of credit on my personal residence. So that worked out great. Got 90% loan to value. So that was a nice little, whatever, $35,000 line of credit going. Ended up, I know you've probably met and talked with Mindy Templeton. She's a great local resource here in Kansas City. We met like kind of right when COVID started happening. We just got on like a Zoom call together. We had a lot in common. We kind of hit it off. Long story short, she ended up bringing us an off-market deal in Raymore. We ended up partnering 50-50 on a flip. So we did that. She bought the house, did the hard money loan in her name. I funded the whole rehab with my HELOC. Turned out very good. We met Danny, who was our contractor at the time. He did the flip for us, worked out really well. Ended up making a very good profit on that house. So once again, that kind of taught me, the ins and outs of a flip, managing a rehab, taught me how to use, other people's money, the HELOC. To go and kind of, double my money pretty quickly with that. So that worked out well. Got that done with, was still slowly building this agent business. Started to kind of have a little bit more money coming in from that. I think it was April 2021. I was sitting what I thought at the time pretty liquid. I was probably sitting on like 65,000 cash. Which is pretty good, at the time. I guess 24, 25, mid 2021. Honestly, just thought I was going to go put 25% down on like a small multi somewhere here in KC and just let it cash flow. Ended up having a lady in one of our local Facebook groups, specific to the Waldo area where I'm at. She posted, was just like, I have this 2-bed, 1-bath, fixer-upper rental in Waldo, looking to sell it. So, of course, I messaged her right away. It ended up being like 10, 12 houses down from me on the exact same street I lived. Was in great shape, just way, way below market rents, needed a full cosmetic. Anyways, met her the next day, made an offer that I thought was very fair. She agreed. Kind of same thing. I made her like a cash offer, a conventional financing offer. And then we actually ended up agreeing on seller financing. So she brought it up to me, which was very crazy to me because I had looked for seller financing at the time all over, couldn't find it. And she brought it up to me because she understood that this would minimize her tax liability at the time. So we did 20% down, pretty standard that you would see at the bank, 4.5% risk on a seller finance on a 5-year balloon with a 30-year amortization. The tenants were actually out before closing. So I quickly, this was, 2 months after the flip, had that same contractor come in, do a full rehab, furnished it, threw it on Airbnb. And that kind of just took off. So did that one. So at that time, 3 houses, finished that rehab, got it leased or got it furnished and put on Airbnb. A month, 2 months later, a house 4 doors down from me pops up on the market at just like a crazy low price. Since I lived in the neighborhood, I just knew prices like the back of my hand very well. I see this 3-bed, 2-bath house, which like the standard at the time was like 230 a square foot. It went up and it was in great condition, like needed almost nothing besides like new main floor, like living area flooring. They listed it for like 115 a square foot. Wow. So I was like, okay, I don't know what's going on here, but I actually had a client look at it. He was like, I don't know, the numbers are a little bit tight. And I was like, that's fine because I'm going to buy it myself. So I went ahead and did that. And I knew I was going to do the BRRRR process on that. So ended up reaching out to a hard money lender and closing on that with hard money, which basically acted as like a cash offer at the time. So yeah, bought that one for $145,000. Literally did like, I think I spent like $7,000 on the rehab. It was just flooring, touch-ups, a little bit of foundation work. Got that leased out before the first mortgage payment was due.
Wow.
Those tenants, once again, have been there for, the whole time now. They re-signed 7 months later. So I bought it for $145, did like $8,000 rehab. Had no holding costs because it was rented out before the first hard money payment. So I was actually cash flowing on hard money.
That's impressive.
The appraisal came in at like 222, so 222,000 7 months later. I mean, even the appraiser called me. She was like, "Did you do anything to this house? I can see you just bought it for like almost 100K less than this." I was like, "Yeah, no, I knew the market very well, and I don't think that listing agent really had an idea of what the pricing was going for." So I took full advantage of that. So quickly got 3 houses on the same street. So now I had 2 rentals, an Airbnb, things were going good. Had the agent business started scaling up quite a bit, like I talked about. I think that July, I did $1 million in volume, which of course as an agent, it's like, depending on your commission splits, is anywhere from like 25 to 30K a month. So quickly replenished all this money I used for down payments, rehabs, quickly replenished it, was liquid again. At this time, I was teetering with the idea of self-storage. Just in the back of my mind and what I had studied on it, basically via AJ Osborne, who's a Bigger Pockets guy.
Okay. I
was just like, this asset class seems pretty simple. Like you're not dealing with the tenants, the toilets that people always talk about. Just seemed like it would be quite passive, just a good investment. So long story short, we go down to like the Ozarks quite a bit. So it's about 2 hours away from Kansas City. For some reason, I was just like, that market seems like it would be solid. A lot of people have condos instead of houses. People have boats, trailers, trucks, a ton of like skiing, tubing equipment.
A lot of money.
Yeah, a lot of money moving around, a lot of just
stuff to store.
Moving part, yeah, exactly. So long story short, just picked up the phone and started cold calling storage facilities down there. It was probably the 3rd storage facility I called that I just saw had no website. They had like 1 Google review. It was like a 2-star review. It was terrible. Just mom and pop ran. I called the office. The lady gave me the owner's cell phone number, and all I did was ask for it, which would never happen typically.
You're right.
Called the guy. We hit it off for like 30, 40 minutes. Next thing I know, a month later, I'm like down there walking through it with him. We put it under contract. I say we, I have a partner. We're 50-50. We walked into the local bank down there. They're like, yeah, we could do 15% down, 4.1% interest on a 5-year note. It was like 25-year amortization, something like that. And we didn't really know anything. I mean, I thought I knew something about self-storage, but at the time it really was just these numbers look like they're going to work, right?
Right.
And here we go. So bought the Airbnb. 2 months later, bought the other rental. 2 months later, bought this self-storage facility. So really just scaled up. And then the self-storage facility was just, by the time we closed on it, we started raising rents. We put in the software and the website, started doing better than we even projected. Going from early 2021, 2 houses, 1 personal, 1 rental, to ending 2021 with 4 houses, 1 self-storage facility, and then basically working very minimal as a nurse. So it was a big transition. You know, all of a sudden I'm starting to close 4 or 5 transactions a month as an agent with out-of-state clients, mainly out-of-state investing clients. So that scaled up. The income kind of replaced the nursing salary. Little did we know, we were just getting our feet wet in the storage facility business, still learning a lot, but it was going well. We liked it. Little did we know that the owner who sold us the first one, he owned another one just down the road. So of course, at the closing of the first storage facility, he was like, well, you know, maybe you guys could buy the next one. In the back of our minds, we're like, yeah, absolutely. So long story short, we closed on that first one like August of 2021. We went down there in the winter, kind of walked through the next one, ran through the numbers. He told us the price he wanted. And once again, we were just like, okay, these numbers are like unreal, especially with the expense ratio. I mean, at the time it was making, I think he was bringing in like $10,000 a month, well below market rent. And he was like, yeah, you know, we'll take $750K for this. And this is a store, right? There's no HVAC, there's no toilets, there's no plumbing, very minimal electrical, there's like no landscaping. So all these big, there's metal buildings. We're just renting out, you know, concrete slabs, basically. Like the expense ratio is just so much lower. So like running it at like a standard, you know, 30% expense ratio, like you would like multifamily or single family. Like we still did that, but at the same time, we knew in the back of our heads, like this thing's going to run at like an 8% expense ratio. And at that time, they had 2 ladies on site that were, you know, basically answering phone calls and running a U-Haul service, and that's all they were doing. So this is when it comes into play, like in another light bulb moment of commercial real estate versus residential and the opportunity it presents. So leads us into early 2022. We ended up purchasing this second storage facility. This put us at about, the first one was 105 units. This one was 100 units, but it had like 50,000 square feet of outdoor parking. So just a gravel flat lot that people were just parking cars, trailers, RVs, fifth wheels, whatever, boats, you name it, we would allow it to like park there. And once again, going back to like keep it simple, passive investing, like it's really hard. I mean, when you're collecting $40 a month just for someone to like park a car on like a gravel lot, like, you can sleep pretty well at night knowing like, yeah, it's really hard to like for them to damage a gravel lot. Like there's not much. And the big thing is like, okay, so that first one, you know, we bought 106 units for $330,000. That was the purchase price on that first storage facility, which some people, they're like, wow, this seems really cheap. And realistically it was. The second one, still only 100 units, but we paid $750K. But this second one had a 6,000 square foot warehouse that came with it. So it's 6 acres, 100 units, almost an acre of like outdoor parking, and then this 6,000 square foot warehouse that was well below market rent as well. And they were moving out. So, I mean, this just wealth creation and passive income, I mean, this deal was a killer. I mean, so we bought it $750K. It's bringing in $10,000 a month at time of purchase. The ladies, there's 2 ladies that are both working part-time. I think payroll was like $2,500, $3,000 a month for them to like hardly do anything besides run the U-Haul service, which when we really dug into the numbers of the U-Haul service, the margins were crap. Like they were not making anything off the U-Haul service. So long story short, we purchased this. So of course, this one was pretty similar financing, went to a bank. They gave us, we did do 20% down on this one.
It's pretty good that you were getting 15 and 20% down on these deals.
Yeah, we were pretty excited. And then we'll get into the next storage facility, which we also did 20% down. So we love that. This one, once again, was like 4.2% interest on a 5-year note on a 25-year RAM. Fast forward, we bought that in March. Now it's, you know, October, November now. we took that 10,000, we got that tenant out of the 6,000 square foot warehouse. We raised that rent pretty significantly. We started raising rents around the facilities because they were well below market rent. Another reason we like storage, it's very easy to raise rents $5, $10 per unit versus like a single family where you're raising 50 to 60 bucks. All the tenants that would turn over, so all the units that would get re-rented, we would go to market rent while they were vacant and then get that. So going from 10,000 a month, now we're going a standard month. We're doing anywhere from like 13,500 to 14,000 a month.
Okay. Wow.
And we got rid of the ladies because we implemented that software. So we self-manage now. So we're saving about 3,000 a month in expenses.
Wow.
That's great.
So basically we were able to create, 6,000 a month extra income at the property within 6-7 months.
Wow.
And this is, once again, going back to commercial real estate where the valuation at the bank and on a purchase by anybody, it's based off the cap rates, right? It's not a sales comparison approach for the most part. They're like, what is the income? What's the expenses? And what's the standard like cap rate for that market? So an extra $6,000 a month for us is bringing in an extra $72,000 a year.
Right.
At like a standard, 7 cap. Let's do some quick math here.
Yeah, it's quite a lot.
We just forced like 600-700K in value. So that's where a lot of this wealth and passive income has come. Just running the numbers. It's
like another $1 million.
Yeah. Of course, we're like just paying down debt right now, but when the 5-year note comes, we'll refinance unless somebody brings us like a silly offer beforehand and we just can't say no to it. But yeah, we're going to quote unquote BRRRR these storage facilities, which most people are like, oh, you're doing the BRRRR process. It's just a longer time period because we want to pay down the debt because right now, we're getting 65-70% cash on cash. So there's just no need for us to refinance really. So yeah. And so when you get into big deals like that, I love these 100K, 150K single family houses that you can BRRRR, flip, have multiple exit strategies. But when I can go buy a $750,000 property and I'm getting 70% cash on cash, yeah, I'll take that all day long of, 70% cash on cash on a 70K like investment starts to scale quite a bit.
Yeah, that's great.
So that's early 2022. Once again, the agent business is scaling up from my active income, the passive income scaling up via mainly self-storage. The net worth has gone exponential at this point because of these deals we're doing.
Right.
So of course, I'm just getting warmed up. I'm all fired up. We love storage.
Storage trade.
Yeah, let's roll.
Storage king.
And I'm still I'm got the Airbnb going. I hit Superhost status. I'm self-managing that. It starts to print some more money, start outsourcing some more things, some rents at the single families casually. I think 2021, I ended up doing, like $5 million in volume as an agent.
Wow.
It's November 2022 now. I think I'm going to end up doing just over $8 million in volume this year as an agent, which is solid. Trying to build a storage facility business more basically. I'm a big proponent of like buying and selling portfolios. Mm-hmm. So of course we're focused on like buying around the same area. Yeah. Kind of the same idea of the 3 houses I have in this area in Kansas City, Waldo. Having 3 houses on the same street, exit strategy, you could sell all 3 because a lot of single family investors, because a lot of people are single family home investors, are going to have to go buy one in Independence, one in the Northland, mm-hmm. one in South KC. It makes economies of scale hard. It makes maintenance hard. It makes management a little bit more hard. Whereas you can go buy 3 at one time on the same street. I like that idea.
It's a lot. I can tell you from experience, it's a lot easier to get a handyman or somebody over there to fix problems. You have everything on the same street.
Exactly. And even just small things that people don't think about. If you have a handyman cleaning gutters, he can knock out 3 and, I live on the street, so I've cut the grass myself. That's going to get outsourced, of course, but I was able to literally walk 4 doors down, cut the grass. It would take me 15 minutes. Why would I outsource that? That's like $100 per hour task. I'm okay with that right now. But even moving forward, if I get a young kid in the neighborhood, he can go knock out 3 lawns for whatever, $20 a lawn. Mm-hmm. Pretty easy business. So we closed on that one in March. Got our feet wet, more wet in the business. Started implementing the software, raising rents, got rid of those employees. So we're full-time management now. We do a little bit of CapEx. The main CapEx we did at that first one was we just had to reseal the asphalt lot. The business paid for that itself, though. At this one we just bought, it's like, it's literally like 4 or 5 acres of gravel. So we did have to bring in like several trucks of gravel just to make it look a little bit better, smoother process for the clients, whatever you want to call it. But we, currently right now we're 96% occupied at both of those.
Wow.
And we've raised rents. That's pretty standard. Once again, just between those 2 storage facilities, looking back, we paid over just $1 million for those 2. And right now we're doing like $19,000 a month in revenue. Like I said, that cash on cash, the expense ratio being so low. Those things are just ATM machines for us right now.
Right.
So we like that. So of course, we're kind of just paying down some debt, building up the reserves account. My partner, he's a CPA, so that helps a lot. He does the books for us. When I kind of handle like business cell phone, like I'll answer phone calls, stuff like that. It's very easy to remotely manage for us via a software called Easy Storage Solutions. So that's kind of how we're doing that. I get down to the Lake of the Ozarks Memorial Day weekend just because it's summertime, the lake's open and starting to pop off. I was down there for a golf trip. We ended up like going to this gas station nearby where we were staying, and I drove by this beautiful RV boat parking storage complex. And I'm like, that looks sexy. That looks like a sexy asset class to me. It seems very passive. It's just down the road from our other 2. So of course I do my due diligence. I look up the LLC. We find the owner. I cold call the owner. Once again, we just hit it off. It just so happened he grew up like basically in the same neighborhood as me in St. Louis.
Wow.
He went to the same grade school as me, which was a very small grade school. And it just so happened that he was in his mid 70s and he was ready to sell. So he was like, you caught me at a good time. Little did I know that he did not just own the RV and boat parking, which is like 45 like open slips basically.
Okay.
But he also owned the retail commercial center in front of it. And then he owned a self-storage facility down the road that had like an additional 250 storage units with a mixture of climate control, the whole shebang. So of course I'm like talking to him, like geeking over here. I'm like writing down all these notes. I'm like, all right, this guy actually wants an offer from us. Then he hits me with like, we're doing $400K a year gross revenue. So immediately in my head, I'm like, okay, he's going to want $4 million for this property. Like,
right.
How are we going to pull this one off? So I call my partner. I'm like, look, this guy wants an offer. This is like an A-class facility just down the road from our other ones. Like, we got to at least walk through this, tour it with him. So of course we call him again. He gives us a full tour. We go through the financials. He basically tells us basically the valuation he wants to sell at. Anyways, we started rationalizing what we're going to do. We know we have to raise money for this. We had a couple private individuals who saw how well we were doing with the storage
right.
we were getting, so they were interested. Long story short, we make an offer. They rebuttal us, so we make an offer for $3 million.
Okay.
They come back. We sit down. They basically came back and said they want like 3.65. So pretty far off.
Yeah.
We go back to the numbers, crunch the numbers, talk about interest rates where they're at. Basically come back to them. We're like, look, we can come up to 3.2. They called us basically immediately and said, we'll accept that. So we're like, awesome. We're buying like a $3.2 million storage facility. I definitely don't have enough money for that. My partner definitely didn't have enough money for that. So crunch time. And then we go back to the bank, and we had 3 banks in mind. The first bank kind of fell off. They were not giving us the terms we needed whatsoever.
Okay.
The second bank basically came back, and we were promised 80% loan to value, certain terms. He basically came back and was like, look, we're going to have to do 25% down. So of course, when you get to that $3.2 million,
that's a lot.
That's an extra, $200K to bring to the table. So we go with a new bank who I actually know the guy via a couple college buddies. He's like, yeah, we can do 80% loan to value. You'll be locked in at 5.5% interest. We can do 12 months interest only.
Wow.
So we did get 2 private individuals that we basically raised $640,000 from. And that was literally like the whole down payment. So we're basically into this deal for like $5,000 out of pocket.
Wow.
Yeah. So originally the plan was for us just to take like a promissory note structure. So we were just going to do a debt structure. So my partner and I would own 100% of the business, and we would basically pay our investors like $70K a year distributions.
Okay.
And that would be paid by the storage facility itself, of course.
Right.
The cash flow. So we take that one to loan committee. They kind of come, and we are already under contract in escrow.
Right.
They kind of come back. They're like, look, the head committee is not cool with that. They want to see these guys have some equity in the deal just because they're, bringing so much money to the table. We get some attorneys involved. We draft up some documents. We ended up having to give up 20% of equity, but still for us to be
still not bad
down for 80% equity in a multi-million-dollar storage business, I was content with. So yeah, we got that one. It was a close call. I ended up having to drive to St. Louis at like 5 a.m. the day of closing to make sure documents got signed and notarized. But yeah, we closed it out. We have a lady on site there. I can dig into the numbers a little bit more, but we're almost 100% full at the actual storage facility itself. The retail center's all full, and then basically right now we're just trying to get the RV and boat storage occupancy up because the owner actually had just finished construction on those. He basically built on an additional 25 units that just happened. So this is a deal that right now it's bringing in a little over $32,000 a month. We think we could get it easily to like $35,000 a month on a specific time frame. We're going to try and optimize expenses a little bit, of course, like we did the last two. We do have to keep this lady on site. It's just too much for us right now.
Sure.
So yeah, basically in a matter of 15 months, we bought 3 storage facilities, which is approximately 500 units. A lot of people in the storage business, they go by like net rentable square footage. So we're over 100,000 square feet of net rentable square footage. Between the 3 of them, kind of doing our due diligence of what 2023 looks like, since it'll be our first full year of operation for all 3 of three ownership. Where it's looking like we'll probably do 650,000 in revenue between the 3 of them. So, at a standard portfolio sale, we think an exit strategy right now, once again, we love the cash flow. But if like a hedge fund were to come in and want to buy a portfolio,
they'll pay a higher multiple.
We'd probably be looking at like $9.5 million at sale.
Wow.
That's awesome.
So
that's quite a bit. Like double what you guys have paid or more than that?
Yeah, so we would be all in for 4.3.
Wow.
I don't think we would sell for less than 9.5, and that's at its current, revenue. We think revenue is going to continue to go up. So that's kind of where we're at. So between all of that, like I said, starting in 2021 with 2 houses, $250 a month passive income, full-time nursing. We're coming to the end of 2022 now, so just over in a matter of 2 years. I just crossed 7 figures, so millionaire net worth.
Congratulations, man.
Yeah, congrats.
Thank you. Thank you. Right now, I'm at about $7,000 a month in net passive income.
Nice.
So that's well above my financial independence number. I mean, my set fixed expenses right now in my life are probably like $3,000 a month.
Yeah.
So quite a surplus there. Of course, as an agent, consistently trying to do deals and bring that active income and just put it back into more passive income. So that's where things are at. So it's scaled up quite quickly. When I started this whole journey, started with Bigger Pockets, Rich Dad, Poor Dad, I had set goals for myself. I was like, by 30 years old, I wanted to have $5,000 a month net income, and I wanted to be 7-figure net worth. Here we are at 26, kind of blew across those numbers. So now I'm just trying to set new standards and see where we can take it. So that's kind of where things are at. Officially got to quit nursing 3-4 months ago. So yeah, that's kind of the story of how things scaled up and where we're at now.
Oh man, it can happen fast.
Yeah.
Open to any questions, anything about storage. I know storage is, you guys are crushing it in the residential real estate space, especially you guys being so young. I wish I would have started crushing it that significantly when I was that young. So I think you guys are well ahead of my curve for sure. But I know a lot of people, when they reach out to me, they want to know a little bit more about self-storage because it's just an asset class that even here at Kansas City, when we go to these meetups, which I'm quite active at,
Sure.
I just don't find many individuals that are in the space, so I could ask quite a bit about it.
Yeah, I've got a good question. I think a lot of listeners would like to hear. So, like, what are a lot of the expenses that go into storage, and what can people expect heading into it?
Yeah, so of course, like the difference between the first two we own and the one we just bought is, of course, we have nobody on site at those first two, so we're not paying anything in management. Eventually, I'm currently, like this morning, I cold called a couple more facilities, just trying to purchase some more. When it gets to a certain point, we're going to have to hire management or figure something out. Because right now, when I'm answering the phones, I'm like, hey, this is Steven with BCM Storage and Osage Secure It. If we were to buy another, I can't be like, hey, this is Steven with blah, 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 like 3 different names. Like, we're either going to have to like re-strategize and remarket it where they're all the same name and like franchise it almost, or just, figure out some sort of VA system or keep people on site. So at our new facility, I mean, we have this lady who's basically there Monday through Friday. She clears out vacant units. She does her walkthrough of like the commercial units. She's cleaning bathrooms, vacuuming, answering all the phone calls, taking like, checks, cash, running credit cards over the phone, the whole shebang. So she's on like a $35,000 a year salary.
Okay.
Of course, us doing, their specifically like $400K gross revenue. So it's like pretty standard of like, I guess that would hypothetically be like an 8% management fee.
Yeah.
But yeah, so the big things are, of course, like we're paying utilities. So depending on the specific location, specific asset of self-storage, like the first two we have, we don't have any climate controlled storage, right? So if you think about, typically residential, like long-term tenants, unless it's like a multifamily that's not sub-metered or something of that sort, you're just having tenants pay utilities for the most part.
Right.
So you don't even really think about it, which is great. When you get into like the short-term or MTR, like middle-term lease type space, like my Airbnb, I have to pay all the utilities at. But at these 2 storage facilities, so I guess the only electrical really, we have 1 electrical panel at each of those. All that really does is run like the electronic gate. So we have like, because when people go to our website to sign up, they sign up, they pay. We basically set them a gate code, and that's how they get in and out of the facility. And then they bring their own lock to lock their unit. So really it's just that gate that's running off the electricity. We have like, we're well lit at night off LED lights. So that electrical bill is pretty low. Of course, we have to pay like sewer bills, which is just like standard down there in Camden County. At our second facility, we do have 1 toilet. So we do have the office that just has this toilet that barely ever gets used. So we are paying just like a minor water bill for that.
Just get it out.
Yeah. But like the first storage facility is just an asphalt lot. So we don't like have to cut the grass. Like we plow the snow in the winter, of course. So there's that expense to, of course, account for. And then our second storage facility, it's just a massive gravel lot. So once again, no like grass cutting. That one, since it's gravel, we're not doing snow plowing at, which is great. Yep. But of course, in the summer, like the weeds can get pretty bad. Like they will still grow through the gravel. So just like spraying for weeds occasionally is an expense. Other than that, they're both fully fenced in. So you do see facilities for sale every once in a while that do not have like gates. It's just an extra precaution, safety. I feel like clients just like it, knowing that their items are well protected. So other than that, we're just paying for like the phone bill, minor electricity, minor plumbing, or minor water, minor sewer. It's pretty minimal, but of course, this new storage facility that we do have climate controlled. Of course, the gas and the electricity bill are a little bit higher because it's climate controlled, right? We do have 7, 8 furnaces, 7, 8 AC units.
So is it like climate control, like AC and heat, like it's capped at a temperature?
Yeah, so it's pretty minimal. Obviously now that it's like, and of course it's in Missouri, so the dead of winter, the summer, those units are going to turn and burn like every other unit. But like in the spring and fall, those things are hardly running. I would have to double check on our numbers, but the way we have it built is that the AC only runs when the temperature rises above like 85 degrees.
Okay.
And then the furnace only kicks on when it drops below like 55 degrees.
Okay.
So they're pretty extremes considering that it is like an insulated metal building.
Right. It's probably staying between that most of the time.
So to stay in between those ranges, I mean, it's hardly running unless it's pretty extreme weather. So that's kind of what we're doing there. The software we use, Easy Store Solutions, I think it's like a $500, maybe $1,000 startup. I think for anything right around 100 units to manage, it costs us like $100 a month.
Great.
And it's such a beautiful software. If you ever get a chance to look it out, it's so user friendly. Like I said, people are just going to the website, they're signing up automatically. We see that come through our email. I'm usually sitting right here in my office, my desk. We just send out a 4 or 5 digit gate code. They put it in, they get into the facility, they bring their own locks, and that's the rest. I mean, the great thing about storage is everything's month to month. So first of all, you could like dynamic price it if you really need to, because everything's month to month, depending on supply demand, because storage really is a supply demand market type thing.
Sure.
So month to month's great. There's a good amount of turnover. I mean, some people are coming in 2-3 months, they're leaving. Other people have been there since like the early 2000s. So it really depends. The crazy thing about storage is like, okay, let's say somebody moves out. I mean, the typical residential unit, of course, you're going to have to like turnover costs of like paint, floors, deep clean it, re-rent it, do all that. With storage, I mean, at our first 2 facilities, obviously climate control is a little bit different, but it's literally just 3-4 pieces of sheet metal and a concrete slab, right? So if somebody calls me, like if somebody were to call me tomorrow morning and say they moved out of their 10 by 10 unit, okay, and a lot of times we ask them just to take a picture of it vacant, because sometimes people do leave stuff. If it's cleaned out, if it looks good, they took all their stuff. I mean, we could have that unit re-rented like 3, 4, 5 hours later for like 30% higher.
3, 4, or 5 hours.
I mean, it's a quick turnover. I mean, we have a waiting list for specific units. A lot of the larger units are in very high demand. Like at our second facility, we have 14 by 45 units. So that's a big unit. I mean, people are having their RVs and boats stored in there. Mm-hmm. Those things are going for, like right now, $195 a month. I think those things could easily go for $230 a month. We're not pushing rents too crazy hard. Obviously, those are bigger units, but we have a waiting list of like 5-6 people for those. So if somebody were to move out, I mean, we have 5-6 people waiting for that unit that we could hypothetically just put rent at what it needs to be. So we love that. And the big thing that I kind of talked about earlier is, now we're at 500 units. Once again, so we have the economies of scale that most people want multifamily for, right? So us being, out of 500 units, I think right now we have like, if we minimized RV and boat of the actual storage, I think we have like 5-6 units available throughout the whole portfolio.
Wow.
If we were to go just raise rents $10, which nobody's going to go like rent a U-Haul and like get all their stuff, hire movers to move their stuff to another storage facility because they're upset we raised their rent $10. That's like $5,000 a month extra. Just $10 raise times 500. I mean, it's very simple. So we like that aspect of it. Missouri specifically, Missouri law is 45 days you can evict. Okay. So instead of having to hire like a lawyer, go to court, kick a family out of a house, throw them on the streets, they're usually punching holes on the way out.
Right.
We can literally just go with like a grinder, some bolt cutters, cut the lock, throw their stuff in a dumpster, auction it off, all within 45 days. So we like that.
Pretty slick.
I was just going to ask that. Awesome.
Yeah. So those are some of the pros and cons. Of course, it's commercial financing. Of course, it's like cap rate based income approach. So it's a little bit different. Once again, the sales comparison approach of residential, which I'm not opposed to residential. I think I will continue to buy single families. I'm starting to see why people go into commercial real estate because it makes much more sense.
Right.
You're definitely capped to a certain extent, but I would say it's much more uncapped where you could buy a house in North Kansas City. You could put all the highest end finishes, make it a luxury unit. It's only going to be able to appraise for what other houses are appraising for. Right. Maybe a bit more because you did nicer finishes. with our storage facility, I mean, we could hypothetically raise rates like to, much higher, and it's just going to continue to go up based off the same cap rate, just off a higher income. Not sales comparison approach, so it's much more uncapped. So there's a lot of pros and cons to that, but I see many more pros to the income-based approach.
Right. Have you ever looked into like developing storage? Like, do you on any of these properties you have? Do you have like enough land that you could develop like additional storage?
Yep. Yeah. So some things we're dealing with now. The first storage facility, we do not have any room. It's pretty maxed out, which is fine. That was like a perfect starter storage facility for us. Like I said, 330,000, 105 units. Pretty simple, great deal. The second storage facility, when I talked about that 50,000 square feet of like outdoor parking, so we've kind of crunched numbers there because we could easily fit 2-3 buildings there, or just one, depending on what size you want to go with on the units. Right? Do you want to do one concrete slab and just do one row of 14 by 45s that are higher price per unit and higher in demand? But of course, it's going back to running the numbers, right? If it takes us $200,000 to develop an additional 25, 30 units, what's your kind of return on investment on that? I think of the market we're in, I think the demand's definitely still there. Clearly by our occupancy, the demand's there.
Right.
In self-storage, typically you are making more per square foot on the smaller units, just because of pricing. But we see that the bigger units are in definitely higher demand. The storage facility we just bought, there is in between the two commercial buildings that came with it, there is a vacant grass lot that's just flat, no trees. The previous owner actually had plans to build a 2-story climate controlled facility there. That was pretty intense.
Yeah, right.
I don't know if we're going to go to that extent.
Do you own that?
We own it. Yeah.
Okay.
So of course, once again, running the supply demand, the feasibility of, is it in demand, running the options of, okay, you have a 2-story facility with the average age of that county. Do people really want to go up a flight of stairs or an elevator just to get to their storage unit? And of course, going back to working with the county to get permits would be complicated. Getting engineers and architects involved for that would be complicated. And then just what would be the overall return on investment? I mean, if it takes us $500,000 to build that, will it produce an additional, 50, 60K a year?
Right.
Potentially. But those are things we're starting to look at. So we do have a couple options to build. A deal I'm actually underwriting right now. So the storage facility we just bought is in Camdenton, Missouri. There's these 2-3 warehouses literally right next door, and there's 4 acres that it backs up to. So the owners of that actually saw that we purchased this new storage facility and reached out to us.
Okay.
So we met them down there. They basically said they're ready to sell. So of course we see the opportunity to literally buy 4 acres next door to potentially expand. But there's just so many factors that go into it. We would have to get easements. The land would have to be excavated, cut down trees. There's a lot of factors. So we are starting to see some options with that. So that is probably the biggest deal I'm underwriting right now, is making them a letter of intent, and they are open to seller financing. So I'm probably going to submit something this week. It would not be a great cash on cash play for me, which is obviously mostly of my focus right now.
Yeah.
Now that I've to 7K a month, how quickly can I get to 10K a month income? And of course that is net after all expenses. So it would be probably a single digit cash on cash play for me. But at the same time, I'm trying to picture the long-term vision of buying 4 acres next to a massive storage facility we just bought and what we could do with that. So that's something I'm trying to rationalize. At our RV and boat storage, so that's actually just covered parking. So it's like 3-sided enclosed, if you can picture that.
Yeah, we've got one in town like that.
Yeah, exactly. So something we're starting to see is a lot of people who reach out want it to be fully enclosed. So we are getting bids to fully enclose those units, to basically put a roll-up door, fully enclose it to make an actual storage unit versus just like covered parking. We think there's enough demand for that as well, where, currently for a 14 by 45 covered parking spot, we're charging like $225 a month. which people are typically willing to pay for. Like if they go drop 150K on a new RV, they're willing to pay premium for a premium.
Yeah, make sure it doesn't get damaged.
But we're trying to run the math of, depending what these bids come back at, as if it costs us $7,000 per unit to fully enclose them, can we raise that rent to like $350 a month? And does that make sense? So
right.
Those are some of the things we're seeing right now. But yeah, that's where I'm at with my current portfolio and kind of what we're looking at.
So are you more focusing on like value adding your current portfolio that I guess you just recently got it. So it's not like it's like the body's still warm, but focusing more on that as opposed to maybe just like seeing if you can go out and get more facilities, and do these deals.
Yeah. That's something I'm constantly contemplating. Like I said, we're like, if we do the deal where we're going to enclose these RV boat units, are we going to spend our own money to do that? And what's the return on that? Obviously, I prefer right now to just buy existing storage versus developing, because material costs are still up.
Yep.
A lot of these construction loans may or may not be adjustable rate mortgages, and rates are kind of all over the place. So that makes it a little interesting. So a lot of stuff going on. Like I said, I'm getting sent like mixed use buildings in Kansas City. Residential, of course, is still great in Kansas City.
Right.
My partner, we're starting to figure some stuff out. Like I said, he's a CPA, which is great because he does our books.
Mm-hmm.
And we kind of both have our own skill sets. I'm definitely more on the sales side. I mean, I'm the one who's kind of approached all the owners to purchase. So honestly, right now, I'm just starting to call more facilities down there at the Ozarks to kind of figure out who may or may not be willing to sell.
Right.
A lot of them want too much, so it doesn't make much sense.
So it's not like everyone just wants to sell you their facility at a great price.
Yeah, not everybody just wants to sell us like 12 cap storage facilities. So
what?
But the value add, we're still going to continue to raise rents at the storage. I'm always constantly thinking about trading up. Do I sell my single families and just go into a monster storage facility? Do I just buy these small warehouses down there here in KC? I'm just looking all over.
Would you, so like on these warehouses, like are they big enough to where you could turn those into storage, or would you just rent them out as warehouses as they sit?
Yeah, so currently they are leased out by businesses.
Okay.
And those are rented out or leased out on their leases till 2025.
Okay.
So there's guaranteed income, and they actually, in the lease, it says the rent increases by the CPI presented by Wall Street on the 12th of like each year.
Okay.
So technically rates could go up by, anywhere from 5 to 10% a year.
Automatically.
Yeah.
Oh, wow.
So they are leased out. They could hypothetically be converted at some point. Yeah, I just don't know. Like I said, it's just interesting. Am I willing to pay to basically purchase 4 acres of dry, flat, grass land to potentially expand, but only get 8% cash on cash in the meantime?
Mm-hmm.
When my last 3 deals have been exponential cash on cash deals. And then I don't know if you have any questions about us raising the money. Like I said, we did an 80-20 split on equity. The investors had to guarantee the loan for 20% with that 20% equity. I don't know if I will continue to raise money, probably for bigger deals.
Right.
We're paying them 12% on their money.
Okay.
They're basically getting $70K a year distributions.
Okay.
A big thing with this deal that kind of goes overseen, as much as I love cash on cash, when you buy a $3.2 million deal, you get to cost segregation study it.
Yep.
Since I am a licensed agent, I am a real estate professional by tax law. So, I'm going to go ahead and, make whatever 180, 200K as a real estate agent this year. I will get to write off basically 40% of that cost seg against that active income.
Oh, like all of it.
That should save me quite a bit on taxes, which is great. Of course, a cost seg study costs, 5, 7K, but if you can save 30,000 in taxes, then it makes sense. So
right. No, that's huge, man. I think that's incredible. Because we're finding a lot of these as like the exponential growth curve of your knowledge and like abilities to sell and put things together. Like it's kind of happened in our various realm. I do have questions about like raising the money, and you kind of answered it a little bit, but like, you had to give up 20% equity for the bank, but like you're also giving them essentially 12% on their money or preferred return or interest, whatever you want to call it, in this particular situation. Is there any, like, how did you go about raising the money? Were these guys you knew, or were they, hey, you had the deal and you just started picking up the phone and calling? Like, how did that work?
Yeah, so there were connections we already knew. So they both, at least one of them, basically has a second home at like the Ozarks.
Okay.
So we know him very well. The other guy was a business partner of his. They just, like I said, they knew we were doing storage. They saw that we were getting very good returns. We were presented with this bigger deal, so we had kind of put a bug in their ear that you would hypothetically have an option to co-invest with us on this deal. 12% is probably a little bit higher than I would like to pay in the future, but to do it for the first time, to get into this deal, once we showed them the financials, how they would get paid out via the cash flow, via the distributions, what the 5-year mark on a refinance or sale looks like for their payoff.
Okay.
And luckily they were quite liquid at the time as well, because they had just refinanced their portfolio. I mean, they're both pretty high net worth individuals. Okay. You know, the one guy in particular, I don't know as well as the other. The guy I do know, I mean, he owns several triple net commercial buildings, several gas stations, owns about 100 units in Parkville.
Wow.
So very high net worth individual. Between the two of them, it was about over $320K each. They're just at the point that they don't want to actively invest anymore. So when you see people who are just sitting on capital like that after a refinance, it's really a good opportunity to co-invest. I wouldn't consider
making 12% with 20% equity is pretty good for them.
Exactly. So in our thought, I mean, of course, you know, we bought it for 3.2. I think as it stands right now, easily worth, you know, 3.5, probably more than that, to be honest. So we're not really going to take much cash flow from it. Yeah. I mean, it's once again a delayed gratification play for me. But of course, that was like a quick 120, 130K added to my net worth by just closing that deal. The thought is, you know, right now at 32K a month income, a certain standard of expenses, in 5 years, if we can get income to, you know, 35,000 a month, optimize expenses a little bit better, you know, just continue to raise rents, potentially do something different with management, I think we could easily refinance at like 3.8, 3.9, or potentially sell 4 plus. So the thought is, in the ideal world, is get to the point in 5 years, it's worth, you know, 3.8, 3.9, do a 75, 80% loan to value cash out refinance, pay them off, and then we're into the deal and own, you know, a $4 million self-storage facility for almost nothing out of pocket.
And there's like a buyout agreement in place for them.
Yeah. There's a certain standard. Of course, they get their 20% based off the value, and then there's a certain balloon based off of that initial investment of 640, subtracted by, you know, the interest we're paying off 70K a year. So
are you paying them interest only?
We got interest only on the debt from the bank.
Okay.
So obviously on this size of a deal, that's huge. It's great up front because we're building a reserves account. We're getting our feet wet in this new facility. Right. Of course, that hurts a little bit in year 5 because you're not paying down any principal. But yeah, on this size of deal, I mean, I think it's an extra, you know, 5,000 a month income.
Right. You're just repaying the private investors on a balloon. You're not paying them monthly interest, or you said you're paying a $70,000 yearly dividend. Is that principal and interest, or how is that amortized?
So we're just paying straight up 70K a year distributions. So it's amortized. I don't know exactly how it's amortized, but it's based off the interest that we agreed upon. Of course, this is all attorney approved on both sides on legal documents.
Sure.
My attorney handles all that.
Yeah. So, and I don't do the books, but of course I'm pretty good at running numbers, I like to think. So we are going to pay them monthly based off the 70K a year, and that's minimized based off their interest owed to the balloon. And so it's all calculated out. I couldn't tell you specifics off the top of my head.
I was just curious.
That is how we set it up. And of course, you know, like I said, interest only on a deal like this, extra 5K a month. Big. That's an extra 70K year 1 in the reserves account. So
that's awesome, man. That's incredible.
Hypothetically, 7-8 million in assets under management, storage, buying another house next week. So that'll put me at 5 single families. Trying to set some new goals, set some new standards, learning to outsource some other things, trying to build an agent, not really a team, but just outsource some things on the agent side of things. Figure out if I want to scale up the agent side of income, keep raising money, go after whale deals, big old deals of storage, trying to figure out the next step. And once you hit 7 figures, nothing really changes. I mean, you become accredited, so more options open up that in that aspect. I'll probably join this mastermind called Go Abundance that you do
I've
have
heard of
a
that.
bigger net worth to join. But right now, I think the goal is just trying to figure out how to go from 7 to 8 figures net worth. You know, once you start getting into the business, doing big things, your expectations kind of change. And so can I hit 10 million and 35K a month net by 35? I think so. And so that's probably one of my next milestones. So
100%, man. You definitely can, especially, you know, it'll just get bigger and bigger.
Yeah, absolutely. So that is kind of where things are at right now with myself.
That's awesome, man. You're really inspirational. It's cool to see you blow up this fast.
Yeah. Hey, you guys are just moments away. Trust me.
I can feel it, man.
Yeah,
it's been pretty exponential for us too.
Real estate's crazy, man. It's just a big old snowball. I mean, somebody told me before I started this whole journey, they're like, the quickest way to $1 million is to owe $1 million.
Yeah.
That starts to make a lot of sense. You know, I personally guarantee about 2 million in debt right now, something like that, whatever it is. It's a little bit crazy for the standard person. You know, obviously you get in these groups, masterminds, meetups. It makes a lot more sense talking to those people. But when you kind of talk with standard, you know, some of your old friends or just like
they just don't get it.
Lightweight people, I'm like, yeah, you know, I'm paying, you know, 7, 8 mortgages a month, whatever. They're like, what? And so, yeah, it's cool. Once again, delayed gratification is a big thing for me. I lived in this little 900 square foot house and paid $400 a month for my mortgage for the last 3 years while making $200K a year type thing. We're buying a little bit of a nicer house right now. I mean, definitely as you scale up to avoid the lifestyle creep of, I see it all the time. A real estate agent will have a really good year. They go out and buy their dream car.
Lifestyle inflation.
And yeah. So, I mean, that's $7K a month. I'm not even using it right now. I don't touch it. It's just going on in reserves, back into other deals. So I don't know at what point I'll start to kind of see the fruits of my labor and utilize it. But I definitely, you know, here approaching my the big 30, probably start to travel quite a bit more, enjoy it a little bit, and kind of just go from there. And once again, you know, you hit the 7 figures, nothing really changes. I'm a simple kind of guy.
Yeah.
Maybe start to dabble with some, you know, limited partnerships and bigger deals and see how other syndicators work. So we'll see.
That's awesome, man. No, it's really cool. We're gonna we got to get past you here soon. So
yeah, I love to see it.
Keep coming. We'll keep meeting up. No, it's really cool. I think it's really neat just jumping in and figuring out storage and just doubling down 2 times and just going and doing it more. I mean, it's awesome. Well, cool, man. Well, how can people work with you or go find you or just work with you?
Yeah, I'm an open book. Some days get a little bit busy, but happy to help any newer investors kind of dabble, answer any questions about Kansas City's market or just commercial real estate in general, self-storage specifically probably. So on Facebook, I'm just Stephen May, Stephen with a V, May like the month. Instagram, I'm Stephen May _real estate. Those are probably the easiest ways to reach out. Yeah.
So check it out down below, guys. We'll put it down below. Just go and check out Stephen. Go sell your house with Stephen and sell him a storage facility under market.
Yeah. There we go. I would love that.
You want to get involved with him, storage and stuff in Kansas City. He's a great guy. I've met him a ton of times, come to a lot of meetups with him, and really genuine and solid and, you know, definitely a great guy to work with. So yeah, go work with Stephen.
I appreciate it. Appreciate the time, guys.
Yep.
Absolutely.
Awesome,
all right.
Coming on. Really appreciate it.
All right. Later, guys. I'm sure I'll see you later this week.
Yeah.
All right. Wow.
Sounds good.
Thank you guys for watching. That was Stephen May. Go check him out in the description below, guys. If you like that, please let me know. Hit the like button. Hit the subscribe button for more awesome interviews. Subscribe to the channel. I'm Dan Cohan. We'll see you in the next video.